Understanding Investments a Few Minutes at a Time by Daniel Dower, from Chapter 8, A Little Game Theory, Issue Number 32, Geometric Mean. Most of us do not think about geometric mean, a linked series, defined as the product of the data set to the 1 over n power. When investing, we call the geometric mean of our returns the compound annual growth rate. For a narrow data set, the arithmetic mean and the geometric mean are fairly close. But for something more akin to the returns of the S&P 500, with a standard deviation in excess of 20%, the difference is substantial. This table compares a few small data sets that challenge our everyday use of the word average. We may simplify this by asking, how much money will you have after losing 50% and then gaining 50%? Most people will quickly answer 100%, based on our ordinary experience of average. When asked, is that your final answer, most will just as quickly see the mistake. Starting with $100, a 50% loss leaves us only $50. And a 50% gain on that amount gives us an ending balance of $75. A lot less than the original investment. Mathematically, the arithmetic mean is 1.0. However, the geometric mean is 0.75. When investing, we should focus on the geometric mean. This came to my attention abruptly in a classroom discussion of the capital asset pricing model. I don't know what the framers of the model intended, but in practical use, most people, including textbooks and professors, use arithmetic mean instead of geometric mean when calculating average returns. It's easier, but is it accurate? As the standard deviation of the data set increases, the difference between arithmetic mean and geometric mean increases. The thorough textbook would point to Bloom's formula, which suggests that as we increase our investment horizon, we should focus on geometric mean over arithmetic mean. When discussing the average return of a stock over time in an attempt to illustrate the efficacy of CAPM, average is usually defined as the arithmetic mean. While I object to this model's validity, regardless of this choice, I have little interest in the arithmetic mean of my investments as compared to the geometric mean. On Bloomberg Radio, Gary Shilling, an economist and commentator, described this difference as grade school math. The carelessness is unforgivable. The real-world effect is significant, and who knows how many investors have been damaged by such haphazard terminology. Fundamental analysts seek reward, investments that generate higher returns, not risk, volatility. I don't believe that the efficient market hypothesis dictates that our efforts are fruitless. Let's review some empirical data. Most of us have been told that small capitalization stocks, small caps, outperform large caps because large caps are safer, and we all know that in order to get good returns, we have to take risks. Is that true? If so, how true is it? This table depicts the average return for various asset classes from 1926 through 2005. Note that almost all discussions of investment returns are in nominal terms, not real terms. Real means inflation adjusted. Inflation averaged 3.1% over this same period. Most people are surprised to see how big of an impact the standard deviation has on the geometric mean, the compound annual growth rate. Small cap stocks still fared better, but by a significantly smaller margin. Are you willing to accept 60% higher volatility for a 20% higher return? Are you surprised that long-term corporate bonds outperform long-term government bonds even though they are less risky, when risk is defined as volatility or standard deviation? I'd like to reiterate the point that the difference between geometric mean and arithmetic mean is not some abstract academic point. It has a real meaningful effect on your investment returns. Most importantly, always remember, risk does not yield reward.